Hey there, it's John here. Welcome to your Memorial Weekend DC Baltimore real estate update. And every time I do these videos, I feel like I start by saying, we have no shortage of things to talk about today. And here we are again with no shortage of things to talk about today. So as we head into Memorial Weekend, it's pretty interesting is I woke up this morning and there's been a lot of optimism in markets lately. The stock market has made an amazing rebound. And actually since our last video where we were up another, let's say 3, 4, 5%. And that was coming on the heels of the China tariffs being punted in the future. And then everything pivoted a little to this big, beautiful budget bill spending package in Congress. But then all of a sudden this morning, I think Trump just basically threw a grenade on the market with 2 posts. One that basically said, hey, Tim Apple, you need to start making your iPhones in the United States or we're going to put a 25% tariff or something like that. He said, hey, Europe, you're not really moving this tariff discussion forward. So starting June 1st, we're going to put, I forget what it was, 50% or something like that tariff on you. And all of a sudden, markets started unwinding. I think when I woke up and looked at futures, I think the stock market was off 1.5% to 2%, depending on the index. Now, at the time I'm doing this video, it's middle of the day. Things have kind of rebounded a little, but it actually speaks volumes to real estate right now. The level of uncertainty, the inability to plan with conviction. When you think of housing or people buying houses, you have to understand that people do that with long-term stability in mind, right? So I'm not just going to wake up one day and be like, hey, I'm going to go buy a house. You've been thinking about it for quite some time. And then you've been preparing for it as well, whether you're saving up for a down payment, whether you're thinking of raising a family, whether you're thinking of schools, how long you're going to be in that place. Maybe there's an investment component to it. And when you keep shaking things up and when you keep throwing curveballs in life, you start pulling back a little. And I think that's what we're experiencing in DC. So let's dive into, start with inventory. Then I'm going to pivot a little, talk markets. I'm going to talk interest rates, and anything else that kind of pops up and comes to mind that is shaping the DC metro market. Now, I believe, and if you've been following me, you know that I always focus on economic indicators. Part of it can be sort of this big national way of viewing markets, because if the country is doing well, let's say stocks are doing well, and then there's a wealth effect that kind of bleeds into different areas. But real estate is still very local, whether it's supply, how many houses are either being built or available, or whether it's the local economy, how many jobs are available, what are the pay rates of those jobs? Are they expanding? Are they going lower? Are there fears or risks of job loss, local job loss, small business closures? All of that and the ripple effects of that help influence consumer behavior, which then bleeds into housing, inventory, pricing trends, everything else, right? So I always will talk global markets when we have these discussions so you can better understand how that's shaping and influencing markets. So first, let's go ahead and look at the Washington, D.C. metro inventory. I'll do D.C. first and then pivot to Baltimore. And then what you can clearly see is that we are at almost a 5-year high of any month other than this little tiny part here. What is that? The October of 2023. Now, if you go back, October of 2022, if you go back to that moment of time, that's when interest rates jumped up to about 8%. It was peak fear in housing coming off of just massive, robust price appreciation from 2020 and 2021, early 22. And it was sort of this idea of, oh my gosh, like real estate might really fall apart. Like who can afford this stuff? And then all of a sudden, interest rates did start rebounding. Raises, wage increases that wound up coming in the early part of 23 were bananas. Just people were getting 10, 20% raises in January through March that following year. So things started rebalancing a little. But you can just see this little not parabolic, but kind of straight line up, increasing steadily. Now, what I would say since our last update is there was this parabolic rise, maybe sort of middle of the month, and it did kind of flatten just a touch over the last week when I look at my Altos reports. And remember, I'll put the links to all the different Altos reports, both the regional and the counties that I have You can either subscribe to those or you can go ahead and just, kind of click those links. They update every Sunday evening, Monday morning. So you can kind of see have things moved over the last week. Now, one thing I always like adding is just sort of comparing where we are right now to some prior years, just to set some perspective. So, if you look at the first chart, you'd say the sky is falling. Oh my gosh, inventory is like rocketed higher and we've never seen this before. But then if you look at this chart, you'll see I added 2019, 17, and 15 just to give you an idea of where we were. And if we're at 6,000 units today, what are we? We were at like 8, then maybe 10, then maybe 14,000 if you keep going back. So yes, there is a sharp rise in inventory compared to the recent years of record low inventory, but compared to the time before that, we're actually kind of middle of the road. And one could argue just getting a little healthier. So I'm enjoying seeing from a buyer's perspective, I'm actually enjoying seeing this rise in home inventory. Now, here's one thing worth noting that I think is very important. So I just talked about the rise in inventory. So what is exactly happening with the number of contracts being written? So if you think of inventory going up, it can go up for one of two reasons. Number one is that just you have more people rolling out properties for sale. But number two is there just are no buyers. So what if the frequency of new inventory is the same, but then you just had no one buying, and that's why inventory wound up increasing? Now, what's pretty interesting about this chart is you'll see that we actually have about the same number of pending sales in the area that we've been having. So this feels more like people rolling out inventory, and yet there are still buyers out there at the same level that we've experienced, and really just even a smidge higher than we used to. So to me, that is still showing that there is buyer demand. There's just more inventory. And I think because of that, we are going to go through a little bit of price discovery. And I don't think we've had a lot. Well, we've actually had a lot of price discovery in 2020 and 21. That price discovery was like way up. Like no one really knew how high to escalate. A house was listed for, whatever, 700, a million, 1.5. And everyone was trying to figure out, do I escalate 5%, 10%, 300 grand? Like the numbers that we were seeing were insane. And when people sort of go into this price discovery mode, a lot of times they look at it and they say, well, if it's not this house, it's some other house maybe a year from now. And if I feel like the market's going to keep pushing higher, then maybe I'm willing to pay next January's price today. And that next January's price is 12% higher than we are right now. So I better escalate up to that amount, right? So that's sort of a price discovery when values are going way up. Lots of demand, not a lot of supply. When you flip those tables, there's price discovery going the other direction, right? If you're a buyer and you're kind of looking at recent sales, you might say, yeah, I get those recent sales, but now the supply dynamic has changed. And if supply has changed, shouldn't the pricing change? And the reality is yes, in some areas. I would believe, I actually had an agent the other day tell me does a lot of business, has a lot of listings currently. And they were pretty much saying, like, I don't know, if I was a buyer and I wasn't overly picky, I'd probably run around and just write a whole bunch of contracts at 10 or 15% off. And I bet I'd get one. I'd get someone out there that would do it. Now, while I say that in the same breath, I would say that's not everywhere. My last video update, I talked a lot about how I believe real estate right now is more micro than it's ever been. And when I say it's more micro than it's ever been, it means that if you're in this one little area, it might truly behave exactly like the market has been. A little irrational, price escalations, waiving contingencies, competing against other people. But you might have some other areas that are stagnant and sitting. And I had someone say the other day, I don't know if I want to put that offer in because I might insult the seller. The reality is, like, who cares? At least if you and your agent are on the same team and sort of same understanding of what you're trying to accomplish, go write some offers. I do think there is some price discovery happening more in the condo market than the single family market. And again, you can't paint anything with a big broad brush right now. I will say I'm seeing buyers in the middle tier home. They are much pickier. They are much more reluctant to move forward. I've seen some sellers that are probably a little too detached from reality. Here's a prime example. I have a seller right now. They bought a house. I think it was like 2022, maybe it was 2023. So it was only like 2 years. I think when they bought it, the house was listed at like $1 million, and I think they wound up getting it for $935. Now they just listed their house at 1.1. It's clearly overpriced by every measure. Our agent representing our client looked at everything. It's like it's an overpriced house. And I think our person went in, let's say it was $1 million or something like that, or right over $1 million, which is probably about the right number. They did some upgrades. The market has appreciated a little in the last couple of years. And the seller countered it something pretty ridiculous, like just a little bit off. And our buyers very quickly said, okay, we're out. No problem. Thanks. Just, withdraw our contract. We're moving on. 3 days later, we get an email from that listing agent. Hey, do your buyers have a counter? Just wondering, like, do they want to, change something? But our buyers have already moved on. They're already kind of done. They're a little disenfranchised with whatever happened. So, I think sellers need to realize who they're selling to. In this specific case, I think the person moved up. Let's say they sold this 1.1-ish and they're buying something for like 1.5, 1.6. Now, if you're in today's market at today's interest rates buying a house for 1.5 or 1.6 and you didn't need to sell your house first, chances are you're doing pretty well in life, right? So you can afford to move up. Now, the person who's buying your house, I think it's a really good exercise for people to just assume for a second that someone paid 1.1 for this house and they put $200,000 down and they used an interest rate of 6.5%, and just look at that mortgage payment for a second, you as a seller, and say, how easy is it going to be for someone to buy that house at that payment, mixed with a time of uncertainty, whether it's market uncertainty, whether it's interest rate instability, whether it is local economics, government cutbacks, DOGE, government spending, government jobs. I don't know. Like, I would almost like to think as a seller, I would want to be more forgiving, but that's just me. There are some stubborn sellers out there. I think that are a little delusional on what their places are worth. I think that's why some houses are sitting. I think as part of that price discovery, I think sellers should understand that it doesn't take but 1, 2, or 3 houses that sell at a new discovery amount to sort of reset the whole market. And there's an argument for, if you're the first one to reset the market, that you might be the one that wins. So, curious to see how this market unfolds as we go throughout the year. Before I move into the Baltimore market, I do just want to highlight one more time that everything I just said about negotiating and writing offers and trying to get lower prices or concessions and that houses are sitting, I do just want to double down on that fact that it's not everywhere. It is not every house. It is not every community. It's not every county. It is very, very micro right now. You need a really good agent on your side. If someone only sells 3 houses a year, no dig against agents that are not selling a lot of houses right now. But if all you do is sell 3 houses a year in the hot market, and then you represent someone that's looking in an area where inventory is spiking and things are slow, I don't know, what kind of advice are you going to get from that person? If the last 3 contracts they wrote were really aggressive and you had to close fast and waive a bunch of contingencies and stuff, are they going to give you advice that leans in that direction because that's their experience? Or are they going to really unpack the local market and understand those differences? So, just something for you as a home buyer out there to keep in mind. Okay, now over to the Baltimore market, you'll see the similar increase in inventory, but much lower. In DC, if we're at 50% more inventory right now, the DC metro area, the Baltimore market is only about 30% more inventory. Now, to me, this makes sense just because the factors impacting DC, I believe, are different factors that are impacting the Baltimore market. So for instance, if you take the 2020 to 23 era, where everyone sort of rushed into the burbs, which the Baltimore MSA sort of was rewarded by that migration, right? So a lot of people went maybe north to Howard County of DC, or maybe east to Anne Arundel, Annapolis area where I live. A lot of those people kept their properties as rentals. We talked about this in the last video. And I think a lot of the inventory that we're seeing right now are some of those rentals kind of unwinding. So the DC MSA is arguably more sensitive to government cutbacks and Doge and all the stuff, the sort of political instability that we're dealing with right now. And then when you get into the Baltimore MSA, it is more government contracting or defense contracting firms. And I think of all the cuts we keep hearing about, there's much less on the defense side than there is on the social side, right? Department of Education and USAID and all the other things that are probably much more centered in the DC MSA as opposed to the Baltimore MSA. Now, similar as to what we did before, I think we want to look at the prior years of inventory as well. And I mean, it's crazy. We only have 2,000 units. But if you go back to 2019, we're up at 5,000, 2017, 6,000, 3 times more inventory in the Baltimore market. Go back to 2015, we're over 8,000. So 4 times more inventory. So the Baltimore MSA is showing significant signs of stability, even in the face of these of rising inventory. It is feels like much more sound area. Okay, now let's dive into interest rates. So again, this is my bond tracking software, and you know from before that green is good. And today we do see a lot of green, but that wasn't the case over the last week, let's say, because we had that Moody's downgrade. And the thing about the Moody's downgrade, to think about bonds for a second, is when you're a bond investor, I want you to understand how this works. If you buy a U.S. Treasury for, let's say, $100,000. So I'm going to give you, U.S. government, $100,000 today. And today you're going to give me a return of 4.515%, $4,515 a year, every year for the next 10 years of interest. Okay. And then at the end of 10 years, you're going to give me my $100,000 back. So what changes rates over time? Well, inflation is one of those things. So if you're a bond investor and you're locking in a $4,500 return for that $100,000 each year for the next 10 years, you kind of want to know, what is that $4,500 going to allow you to buy? And we know today, $4,500 does not buy you nearly as much as it did back in 2019, right? So if you feel like that trend is going to continue, you might not want $4,500 today locked in for 10 years. You might want $5,000, right? Because you think things will be a little more expensive over time and you're going to want to demand more money today. So that's one thing that influences interest. And it works the other way, right? If you think things are going cheaper and AI is going to crush inflation and we're going to be in a deflationary world, then you might actually have lower rates. That's what we had during pandemic times. That's what we had in 2016 when oil went negative. There's a lot of other periods that we can point to that were deflationary mindsets, which is when interest rates improve. Now, the other thing you're worried about is, will that person be able to pay you back that $100,000 in the end? And that's a very important concept, right? So that sweeps over to the Moody's downgrade. So one part is how much that person's going to pay you year over year. But then the other part is, are you going to be around to give me my $100,000 at the end? The reality is it's U.S. government. The answer is probably yes. I still think we're safer than most every other country in the world. But then the last thing you're worried about is issuance. So you'll hear people talk about, debt issuance or corporate bonds hitting the market, competing with treasuries and mortgage-backed securities. And then I just want you to think about this. If you showed up one day and you could invest your money, would you give Apple or Microsoft your $100,000, or would you give the U.S. Treasury? I mean, for me, I'd probably give it to Apple and Microsoft if all is equal. I believe Apple and Microsoft are better run companies and more likely to give me my $100,000 back at the end of 10 years than maybe the U.S. government, right? So those are all the factors influencing rates. And when the Moody's downgrade came, there was a bit of a sell-off. Again, I'll show you here in a second, rates are very volatile. But then you sort of also look at the big, beautiful budget bill, which arguably is very economically stimulative, which is likely fantastic, right? No tax on tips, no tax on overtime. We have the SALT deduction increase all the way up to $40,000. We don't know all the details yet, but I mean, that could be a $12,000 extra tax refund for some people, especially homeowners. So we'll have to dig into those things. Be sure to follow the channel. I'll do a video on that once we know more. But that's less tax revenue, which means more deficit spending. We already are spending more money this year than we were last year in Biden's last term, even though we have all these Doge supposed cuts. So the market started freaking out a little bit about debt issuance, deficit spending, the government's need to raise even more money at a time when they also have some debt from the pandemic era that is starting to roll that they actually need to refinance. So a lot going on in markets. Now, if we look at this chart right here is the 30-year average rate. Now remember, average rates mean like kind of nothing right now. I would say these average rates are probably represent like a 20% down conventional loan buyer. But someone who might be a first-time home buyer could be 0.5% better than this. Someone that might qualify for some jumbo financing, loans above $800,000, maybe those rates would be, again, another 0.5% or so better than this. So just know everyone kind of gets a different rate based on credit score, down payment, property type. It's much more confusing than it used to be, whether you're a first-time home buyer or not. But you can just look at the general trend, and you'll see that this was April 7th. We were at 6.5, and then by April 11th, we were at 7, right? A 0.5% increase in like a week. It was insane. And then a couple weeks we dropped down 6.8, and now here we are, popped right back up around the 7s, kind of right near the peak of when all this tariff craziness started. And the 10-year bond, same thing. This is actually a 1-hour chart of the 10-year bond, and it's kind of crazy. Here's May 16th. We're at 4.4. That's 9 o'clock in the morning. And then at May 19th, at the following day, we're at 4.5, right? Just big swings, 1/8 to 1/4% move here or there. So the market's just also in a price discovery mode, right? We just talked about sort of supply and demand of housing and price discovery. Well, the bond market is no different. Now, if we switch over to stocks, which I do believe this is something for us to focus on because, again, the stock market bleeds into the wealth effect, right? You look at your financial statements and you're like, oh, my 401k has kind of rallied all the way back. I feel better about life. The more assets you have, the more your money is working for you, the more likely you or people are to buy houses, buy cars, go on vacations, right? Think about the mindset when everything was crashing. It was a hoarder's mindset, a capital preservation mode. Like I'm not doing anything because I don't know what's going on in the world. I'm afraid. The opposite of that is true. So what's interesting is this is the S&P 500, and everyone was pointing sort of towards the 200-day moving average, and there's a confluence of support where they're both almost identical, the 100-day moving average. And you can see today at Trump's sell-off, we jumped right down, pierced the 200, landed at the 100, and then popped right above it, okay? And actually, we're trading fairly well as we go through this day. If you go back a little bit, right here in late March, so it was sort of right after the first big drop of the stock market, we rallied back. We were a couple days over the 200-day moving average, and then we failed, right? Boom, then we plummeted all the way down. So some people are saying that, we popped over those big important moving averages when the China tariffs were postponed, left a little gap there. Some traders always say all gaps are filled, but people can look now at this touch to the 200 and 100-day moving average and rally off as a retest of the major average and showing footing moving forward that, okay, we are not going to retest the lows in the market. The market just hit the 200, bounced off. The trade flow is good. So I think that'll be something interesting to watch, but so far that's very positive. If we go over to the NASDAQ, kind of the same thing, but its technology is holding in much, much, much better. NVIDIA comes out next week, I think, with earnings. There's a Bitcoin conference, I think, coming up. Where is Bitcoin, actually? I think that's an interesting one to look at. So, of course, Bitcoin, I always look at Bitcoin as a true measure of risk in the market. Although for a short period of time, just like a day or two, we had the stock market rolling over while Bitcoin rallied. And that was sort of this idea that Bitcoin is sound money. And if the US government is spending out of control and the bond market is going nuts because of the Moody's downgrade, that a lot of money started flooding into Bitcoin. And we did see that. Bitcoin hit an all-time high. Now, it's since reversed a little bit, but it peaked right about, 111,000, where if I go back to our last update, it was May 7th. We were at 96,000. So 15,000, what's that, a 15% return already on Bitcoin? So it's just interesting to see kind of how markets are reacting. So I think that's about all I want to go over in this video. I know I kind of bounced around, covered a lot, told some stories. What I would say to put a button on where we are in the market today is I would say some areas, especially the high end, are behaving like they have been. So that there's just no different. The wealthy are doing just fine, and they're going to live where they want to live and buy where they want to buy when they want to do it. If the house is available and they like it, they're going to compete for it. I would say the lower end, so think bottom quartile of price. If our median house price, let's say in an area is 800, let's say like 500 and under, I think that market's pretty hot. More in the Baltimore market, definitely in Northern Virginia. I think that is sort of the land of people who buy strategically because they're ready to at that point of life. In many cases, they don't have tremendous assets tied to market, so market volatility is not really on their scope of like paying attention to it. So they just buy when they feel security in their job and they're able to. It's that middle ground is fuzzy. And it's like house to house. I think buyers in that range are very, very picky. I don't think they want to do a lot of work. I think they are opportunistic. I think they will likely look for discounts. I think sellers need to be more realistic as we go through this summer. I think sellers need to understand the competition that they have in their local market, like other houses just like theirs. And I still am bullish, especially in DC. I'm actually very bullish on DC housing right now. It just feels like the prices I'm seeing look pretty good. And I still see a lot of energy and work from home unwinding. I do think once we get this spending package behind us, I think maybe we get some clarity. Are a lot of those cuts that were being talked about, are they sort of put into code of law as opposed to executive action that can be fought in courts? I think so. Get a little bit of that clarity behind us. I think confidence comes back in the market and things start moving again. Between now and then, I think we're in price discovery mode in certain asset classes and in certain areas. If you like to talk about this, you have any questions, drop them in the comments, ping me anytime. And otherwise, have a wonderful vacation. It is vacation season. We're not really doing much. It's going to be lacrosse season for me, girls lacrosse, which I'm not going to lie, I actually really enjoy it. So this is recruiting season for my oldest daughter. And she had a fantastic high school season. Both my girls did. So I'm actually really excited about this summer. The next 2 months, every single weekend, I'm at some tournament on the East Coast mostly, and probably traveling some colleges. And so if anyone has any advice, any parents out there on how this recruiting thing works, just feel free to reach out. I'm going to need some support there too. All right. Till next time, take care.